January 19th, 2026. While the world argued about tariffs, a switch was flipped in Mexico City. Not a rumor, not a negotiation, a policy decision that just severed America's access to nearly half the world's refined silver supply, the metal that powers solar panels, electric vehicles, defense systems, medical devices, suddenly rationed. And here's what most people don't understand yet. This isn't about mining, it's about refining. And when the refining gate closes, the entire supply chain collapses. The question isn't whether prices will rise. The question is, what happens when American factories can't source the metal at any price? Welcome to John Analyst, where we break down the strategic economic shifts that reshape markets before the mainstream catches up. Now, if you've been watching long enough to remember when handshake deals meant something, when a man's word in business actually mattered, then you understand the value of information that arrives early, not late. So do me a favor. If you appreciate analysis that doesn't waste your time with hype, hit that subscribe button, not because I need the number, but because when the next supply shock hits, and it will, you'll want to be in the room when we discuss it. And before we go deeper, drop a comment below and tell me, where are you watching this from? Are you in the States, feeling this squeeze already? Europe, watching from the sidelines, or somewhere else entirely, calculating your next move? Let me know, because geography matters now more than ever. On Sunday evening, January 19th, 2026, a policy document was published in Mexico City. Most people missed it. The language was bureaucratic, technical, forgettable, but the implications were anything but. Mexico had just implemented a new export licensing system for refined silver, and buried in that system was a single mechanism that would change everything. Export licenses would now be granted based on trade cooperation. Translation: countries that Mexico considers non-cooperative in trade negotiations would face severe restrictions on accessing Mexican refined silver. The primary target was obvious: the United States. This was not a mine closure. This was not a labor strike. This was not a temporary disruption caused by weather or accident. This was a deliberate policy decision designed to apply pressure. And the pressure point was chosen with precision. Silver is not just a precious metal. It is an industrial necessity. It conducts electricity better than any other metal at scale. It reflects light with unmatched efficiency. It kills bacteria naturally. These properties make it irreplaceable in solar panels, electric vehicle components, medical instruments, defense electronics, and telecommunications infrastructure. Without silver, entire industries slow down. And here is what makes Mexico's move so strategically effective. Mexico does not just mine silver. Mexico refines it. There's a critical difference. Silver does not come out of the ground as shiny bars with serial numbers stamped on them. It comes out mixed with lead, zinc, copper, and other base metals. To transform raw ore into exchange-deliverable silver bars, a company needs refining capacity. Refining requires furnaces, chemical processes, skilled labor, environmental permits, and most importantly, certification. Only bars produced by approved refiners are accepted by major exchanges like COMEX. Only certified bars can settle futures contracts. Only recognized brands can be used as collateral in financial transactions. And Mexico controls a massive share of global refining capacity, not just for silver mined in Mexico, but for silver mined in other countries and shipped to Mexico for processing. This is the choke point. When Mexico restricts refined silver exports, it is not just restricting Mexican silver. It is restricting access to the entire processing pipeline. And that is where the 45% figure comes from. According to industry estimates, nearly 45% of the refined silver that typically flows into global markets, particularly into the United States, now sits behind an export licensing wall. The United States consumes far more silver than it produces domestically. American mines supply only a fraction of what American industries need. The rest must be imported. And for decades, that import system worked smoothly. Mexican refiners processed concentrates, stamped bars, and shipped them north. American manufacturers ordered what they needed when they needed it. The system was efficient, predictable, invisible. Until now. Now, every shipment requires a license, and licenses are being granted based on political considerations, not market demand. The timing of this policy is not coincidental. It arrives in the middle of escalating trade tensions between the United States and Mexico. Washington has signaled its intention to impose broad tariffs on Mexican goods. Mexico has responded, not with matching tariffs, but with something far more surgical. Silver exports represent a relatively small portion of Mexico's total export revenue. Restricting them does not significantly harm the Mexican economy, but silver is a critical input for multiple high-value American industries. Restricting it creates maximum disruption for the United States. with minimal cost to Mexico. This is economic leverage applied with precision, and the early signs suggest it is working. Within days of the policy announcement, dealers in the United States began reporting unusual activity. Premiums on physical silver, the amount buyers pay above the spot price, started climbing. Lead times for delivery, normally measured in days, began stretching into weeks. Some wholesalers stopped quoting prices entirely, citing supply uncertainty. Industrial procurement managers started making urgent calls to suppliers, asking about guaranteed allocations. These are not the behaviors of a calm market. These are the behaviors of a market that suddenly realizes access is no longer guaranteed. And here's the part that should concern every business owner, every supply chain manager, every corporate strategist watching this unfold. Most people still do not understand what just happened. They see a headline about export licenses. They assume it is temporary. They believe alternative suppliers will step in. They expect negotiations to resolve the issue quickly. But the mechanics of the situation suggest otherwise, because replacing a major refining hub is not something that happens in weeks or months. It is something that takes years. And in the meantime, American industries will be forced to choose. Pay significantly higher prices for limited supply, redesign products to use less silver, relocate manufacturing operations to countries with better access, or reduce output entirely. None of these options are quick. None of them are cheap. And all of them represent a fundamental shift in competitive dynamics. The market is beginning to reprice risk, and the repricing has only just started. There's a question most investors never ask. Where does refined silver actually come from? Not the mine, not the country, not the company name on a press release. The physical infrastructure. The furnaces that process ore, the facilities that turn mixed concentrates into pure metal, the laboratories that verify purity, the certification bodies that approve bars for delivery. This infrastructure is not evenly distributed across the globe. It is concentrated, heavily concentrated. And Mexico sits at the center of that concentration. To understand why this matters, one must understand what refining actually involves. When silver ore comes out of the ground, it is typically bound together with other metals. Lead, zinc, silver deposits are common. Copper-silver combinations are frequent. The raw material is called a concentrate, a mixture that might contain anywhere from 30% to 70% silver, with the rest being other elements. That concentrate cannot be used directly. It must be processed. The process is complex. It involves smelting, chemical separation, electrolytic refining, and casting. Each stage requires specialized equipment. Each stage demands technical expertise. Each stage consumes energy, chemicals, and time. A single refinery can cost hundreds of millions of dollars to build. Environmental permits alone can take years to secure. Hiring and training a skilled workforce is not instantaneous. And once built, a refinery must maintain relationships with miners, logistics providers, and end users. It must achieve certification from organizations like the London Bullion Market Association. It must pass regular audits. It must maintain quality standards that institutional buyers demand. This is not an industry where new capacity appears overnight. This is heavy industry with long lead times and high barriers to entry. Mexico has built this capacity over decades. Major refineries operate in multiple regions. They process not only Mexican-mined silver, but also concentrates imported from Peru, Bolivia, Argentina, and Chile. South American miners often find it more economical to ship concentrates north to Mexico, rather than build their own refining capacity. Mexico has become the processing hub for a significant portion of the Western Hemisphere's silver production. And that is precisely why the export licensing policy is so disruptive. When Mexico restricts refined silver exports, it does not just affect Mexican mines. It affects every operation that routes material through Mexican refineries. The numbers illustrate the scale. According to industry data, the United States consumes approximately 200 million ounces of silver annually. Domestic mine production supplies roughly 30 million ounces. The gap, 170 million ounces, must be imported. Mexico has historically supplied a substantial portion of that import volume. When 45% of that supply suddenly requires export licenses that may or may not be granted, the mathematics becomes stark. Approximately 75 million ounces of annual supply, now uncertain. That is not a minor disruption. That is a structural deficit. And deficits of that magnitude do not resolve quickly. The immediate response from market participants has been predictable. Buyers are attempting to source silver from alternative refiners. Canadian facilities are receiving inquiries. European refiners are being contacted. Asian processors are being approached. But here is the problem. Global refining capacity is not sitting idle. Refineries operate near full capacity under normal conditions. They have existing customers. They have contracted volumes. They have production schedules planned months in advance. When a major buyer suddenly appears, desperate for supply, refiners have leverage. They can demand higher processing fees. They can require long-term commitments. They can prioritize their existing relationships. And even if a refiner agrees to supply additional volume, the logistics are not simple. Silver bars are heavy. They require secure transportation. They require insurance. They require customs clearance. Establishing new supply chains takes time, and time is exactly what American industrial users do not have. Solar panel manufacturers operate on tight production schedules. Electronics companies maintain just-in-time inventory systems. Medical device producers cannot afford extended lead times. Defense contractors work under government deadlines. All of them depend on reliable silver supply. And reliable is no longer guaranteed. The futures market is beginning to reflect this tension. COMEX, the primary exchange for silver futures trading, operates on a simple principle. Most contracts are settled financially. Traders close positions before expiration. Only a small percentage of contracts actually result in physical delivery. This system works as long as participants believe physical delivery is possible if needed. It is a faith-based system. The paper market can be many times larger than available physical inventory because faith keeps the system stable. But when that faith wavers, when industrial users begin to worry that they cannot source metal, when investors start questioning whether delivery is truly guaranteed, the system shows stress. Early indicators are already visible. COMEX has quietly increased margin requirements on silver futures. This is presented as routine risk management. But margin increases make it more expensive to hold positions that demand delivery. It reduces the number of participants who can pressure the physical market. It is a pressure relief valve. And when exchanges start activating pressure relief valves, it means pressure is building. Another indicator, the shape of the futures curve. Under normal conditions, longer-dated contracts trade at a premium to near-term contracts. This is called contango. It reflects storage costs and interest rates, but when physical supply becomes tight, the curve can invert. Near-term contracts become more valuable than future contracts. This is called backwardation. It signals that having metal now is worth more than having metal later, and backwardation is beginning to appear intermittently in silver markets. These are not dramatic headlines. These are technical signals. But technical signals often precede major moves because markets reprice gradually until suddenly they do not. The question now facing every participant in this market is simple. How long does Mexico hold this position? Is this a negotiating tactic that resolves in weeks? Or is this a sustained policy that reshapes supply chains for years? The answer to that question will determine whether this is a temporary disruption or permanent realignment. And right now, no one knows for certain. There are two silver markets now. One exists on screens, the other exists in warehouses, and the distance between them is growing. This is not supposed to happen. In theory, arbitrage keeps prices aligned. If physical silver trades at a premium to paper silver, traders should buy paper and demand delivery. If paper silver trades at a premium to physical, holders should sell metal and short futures. These actions, repeated across thousands of participants, should keep prices synchronized. That is the theory. But theory assumes something critical. It assumes delivery is frictionless. It assumes metal is always available. It assumes logistics work smoothly. And right now, none of those assumptions hold. The first crack appeared in dealer markets, retail silver dealers. The companies that sell coins and bars to individual investors began raising premiums immediately after Mexico's announcement. A premium is the amount charged above the spot price. Under normal conditions, premiums for standard products range between 3 and 6%. Within 72 hours of the policy announcement, some dealers were quoting premiums above 12%. By the end of the first week, certain products carried premiums exceeding 15%, and these were not opportunistic markups. These were survival adjustments. Dealers were receiving calls from their wholesalers. Allocations were being cut. Lead times were extending. Some suppliers stopped taking new orders entirely, citing uncertainty about replenishment. When a dealer cannot guarantee they can replace inventory, they must either raise prices or stop selling. Most chose to raise prices. The industrial market showed similar strain, but less visibly. Large industrial users do not buy silver from retail dealers. They buy directly from refiners, from mining companies, or through specialized brokers. These transactions do not appear on public websites. They happen through private negotiations. But people inside those negotiations began reporting significant changes. Processing fees, the amount refiners charge to convert concentrates into bars, started climbing. Delivery timelines, normally 4 to 6 weeks, began stretching to 8 or 10 weeks. Some refiners introduced allocation systems, limiting how much any single customer could purchase. Others required contract renewals at substantially higher prices. And in several cases, longtime customers were told outright, "We cannot guarantee supply beyond the current quarter." This is not normal market behavior. This is rationing. And rationing, by definition, means supply is constrained. Meanwhile, The futures market continued trading as if nothing fundamental had changed. The spot price, the reference point derived from futures contracts, moved, but not dramatically. It fluctuated within ranges that seemed almost normal. To an outside observer, watching only the charts, the market appeared stable, but charts do not show allocation limits. Charts do not show extended lead times. Charts do not show suppliers refusing to quote prices. Charts show trades that happened. They do not show trades that could not happen. And that gap between what the chart shows and what the physical market experiences is where the real story lives. This divergence creates a measurement problem. When someone asks, "What is the price of silver?" the answer depends entirely on what kind of silver they need and when they need it. If they need a futures contract, they can roll indefinitely. The price is one number. If they need physical bars delivered to a specific location within 30 days, the price is a different number. If they need a continuous supply for industrial production, the price is something else entirely. All three can be called the price of silver, but they are not the same transaction, and in a disruption, the differences magnify. There's a framework for understanding how this unfolds. It happens in phases. Each phase has distinct characteristics. Each phase tells indicators that reveal what is actually happening beneath surface volatility. Phase 1 is immediate reaction. This is the first 2 weeks. Dealers adjust prices rapidly. Industrial buyers begin making calls. Procurement teams start reviewing contracts. Some companies quietly increase inventory orders, trying to build buffer stock before prices rise further. The key indicator in phase 1 is speed. How fast do premiums move? How quickly do lead times extend? The faster the adjustment, the tighter the underlying supply. Phase 2 is strategic repositioning. This typically runs from week 3 through week 6. Industrial users begin making difficult decisions. Do they lock in long-term contracts at elevated prices? Do they attempt to redesign products to use less silver? Do they explore alternative suppliers, even if those suppliers are more expensive or less reliable? This is where the scramble becomes visible to anyone paying attention, because companies do not make these moves unless they believe the disruption is real. Redesigning a product is expensive. Switching suppliers is risky. Locking in high prices can hurt competitiveness. No one does these things casually. When procurement managers start making these calls, it signals belief that the situation will not resolve quickly. Phase 3 is exchange response. This unfolds between week 6 and week 10. Futures exchanges monitor delivery demand closely. Under normal conditions, less than 2% of contracts result in physical delivery. Most traders roll positions forward or close them before expiration. But when supply becomes uncertain, that percentage can rise. If traders believe they cannot source metal elsewhere, they may demand delivery through the exchange. And if too many contracts demand delivery simultaneously, the exchange faces a problem, because COMEX warehouses do not hold unlimited inventory. Registered stocks, the bars available for delivery against futures contracts, fluctuate. On a typical day, registered silver inventory might range between 80 and 120 million ounces. That sounds like a lot. But if even 5% of open interest demanded delivery, it would exceed available stocks. Exchanges know this, and they have tools to manage it. They can raise margin requirements, making it more expensive to hold positions. They can modify delivery rules, changing what qualifies or where delivery can occur. They can introduce cash settlement incentives, encouraging traders to close positions financially rather than take metal. These are presented as technical adjustments, but they are pressure management. And when an exchange starts deploying multiple pressure management tools in a short span, it reveals something important. It reveals that delivery pressure is real. Phase 4 is political intervention. This typically begins around week 8 and can extend indefinitely. When industrial costs rise significantly, companies complain to government officials. Trade associations write letters. Congressional representatives ask questions. Regulatory agencies open inquiries. And bilateral negotiations intensify. This is where the story shifts from market mechanics to diplomatic maneuvering. But here is the critical point. While politicians negotiate, the market keeps moving. Supply chains do not pause for diplomacy. Production schedules do not wait for press conferences. And prices respond to what is actually happening, not to what might happen eventually. Right now, the market is somewhere between phase 2 and phase 3. Dealers have adjusted. Industrial buyers are repositioning. And the first signs of exchange stress are beginning to appear. The question is not whether this progresses further. The question is how fast and how far. Because once a market fractures, putting it back together is never simple. Disruptions reveal who is prepared and who is not. Right now, across boardrooms in the United States, executives are being forced to answer a question they did not expect. What do we do if silver supply remains constrained for months, not weeks? The answer separates companies that survive from companies that struggle, because there is no perfect solution. There are only trade-offs. Each option carries costs. Each option requires decisions that will shape competitiveness for years. The first option is simple: pay the premium, accept higher prices, lock in supply at whatever cost the market demands. For some companies, this is viable. If silver represents a small percentage of total production costs, absorbing the increase may be manageable. A medical device manufacturer using trace amounts of silver in antimicrobial coatings might accept a 50% increase in silver costs if it only raises total product cost by 2%. But for other industries, the math is brutal. Solar panel manufacturers use significant quantities of silver in photovoltaic cells. Silver paste forms the conductive pathways that capture electrical current. An average solar panel contains approximately 20 grams of silver. At scale, this adds up quickly. A manufacturer producing 1 million panels annually requires 20 metric tons of silver. If silver prices rise 40% and premiums add another 15%, that is an additional $11 million in input costs. For an industry already operating on thin margins, this is not trivial. It forces a choice: raise prices and lose competitive advantage, or absorb costs and destroy profitability. Neither option is attractive. The second option is substitution. Redesign products to use less silver or use alternative materials entirely. This is not a new idea. Engineers have been working on silver reduction for years. Thinner conductive lines, more efficient paste formulations, copper-based alternatives. But substitution is not instantaneous. Product redesign requires testing, new materials must be validated, performance must be verified, safety certifications must be obtained, and manufacturing processes must be retooled. For consumer electronics, this timeline might be 12 to 18 months. For medical devices, subject to regulatory approval, it could be 3 years or more. And even when substitution is technically possible, it often comes with performance trade-offs. Copper conducts electricity well, but it corrodes more easily than silver. Alternative conductive materials may work, but they may also reduce product lifespan or efficiency. So substitution solves the cost problem, but introduces new risks. The third option is supply chain diversification. Find alternative refiners, establish relationships with suppliers in different geographic regions, build redundancy into procurement systems. This is the approach favored by risk management professionals. But it is easier said than done. Global refining capacity is limited. The major players are well known, and they are already operating near full capacity. A company attempting to source silver from a Canadian or European refiner will discover quickly everyone else had the same idea. And when demand surges toward limited alternatives, prices rise there too. Moreover, not all refiners produce bars that meet all specifications. Some industrial users require specific purity levels. Some need particular bar sizes. Some need brands that are approved by their customers or insurers. Switching suppliers is not merely a matter of signing a new contract. It is a matter of requalifying materials, updating documentation, and managing logistics, all of which takes time. The fourth option is the most drastic: relocation. Move production facilities to regions with better access to silver supply. This is not a short-term response. This is a strategic repositioning. But it is already being discussed. Because if the United States remains a high-cost, low-certainty market for silver, companies with global operations will shift production to locations with more reliable supply chains. A solar manufacturer might move panel assembly to Mexico, where access to refined silver is prioritized. An electronics company might expand operations in Asia, where supply routes are less affected. This is not theoretical. This is how global manufacturing responds to input cost differentials. And once production capacity relocates, it rarely returns. Because rebuilding after relocation is even more expensive than relocating in the first place. So the companies making these decisions now are shaping industrial geography for decades. Governments are aware of these dynamics. And that brings us to the policy response. The United States has limited options, but it has options. The first is negotiation. Trade representatives can engage Mexican counterparts. Tariffs can be modified. Concessions can be offered. Deals can be structured. But negotiation requires leverage. And right now, Mexico holds the stronger position. Because the United States needs refined silver more urgently than Mexico needs tariff relief. That asymmetry defines the negotiation. The second option is domestic capacity expansion. The United States could incentivize construction of new refining facilities. Tax breaks, subsidies, regulatory fast-tracking, public-private partnerships. In theory, this reduces long-term dependency on Mexican supply. In practice, it is a multi-year project. A modern refinery costs between $300 million and $1 billion to build, depending on capacity and location. Environmental impact studies alone can take 2 years. Permitting can add another year. Construction takes 18 to 24 months, and that assumes no delays, no legal challenges, no funding gaps. So even if a project began today, meaningful new capacity would not come online until late 2028 or 2029. That does not solve the 2026 problem. The third option is strategic stockpile release. The United States maintains strategic reserves of certain critical materials. If a silver reserve exists, and if releasing it is politically feasible, it could provide temporary relief, but reserves are finite. Releasing stockpiled material addresses immediate shortages, but it does not solve structural supply deficits. Once the reserve is depleted, the underlying problem remains. So this is a stopgap, not a solution. The fourth option is policy retaliation. The United States could impose its own export restrictions on materials Mexico needs: natural gas, refined petroleum products, certain agricultural goods, technology components. This is economic warfare. It escalates the conflict rather than resolving it, and it carries risks, because once trade restrictions proliferate, global supply chains fragment, companies face even more uncertainty, costs rise across multiple industries, and the economic damage spreads beyond the original dispute. History suggests this path rarely ends well, so the most likely outcome is a combination. Negotiations continue with incremental progress. Some domestic capacity expansion begins slowly. Industrial users adapt painfully, and prices remain elevated until supply and demand gradually rebalance. But rebalancing takes time, and during that time, the market will remain volatile. Premiums will fluctuate, delivery timelines will vary, and companies will make strategic decisions based on incomplete information. This is the environment that separates prepared organizations from unprepared ones. The prepared have already stress-tested their supply chains. They have identified alternative suppliers. They have built inventory buffers. They have contingency plans. The unprepared are scrambling now. They are discovering that supply chain resilience is not something that can be purchased overnight. It is something that must be built, maintained, and continuously refined. And the cost of not having it is becoming clear. Because in a world where resources are weaponized, access is no longer guaranteed, availability is no longer assumed, and the companies that understand this first are the companies that position themselves to survive. The silver market disruption of 2026 will eventually be studied as a case example. It will appear in business school curricula, it will be analyzed in supply chain conferences, it will be cited in policy debates about critical material security. But for the companies living through it right now, it is not a case study, it is a crisis requiring immediate decisions, and the decisions being made today will determine competitive positioning for the next decade. Because markets remember, industries remember, and once trust in a supply chain is broken, rebuilding it takes far longer than breaking it did.